spending too much time on the computer here. Strategies. So I hit this, generate strategy orders. Bear with me, I'm trying to use my computer. Hit activate strategy, and we're off to the races. So literally, while we're sitting here and while I'm talking to you, this thing's going to generate strategy orders. It's not worth real money. This is a 7 count. We're not that crazy, but this thing is just going to generate orders while we're talking, and it's either going to make money or lose money. And it doesn't really matter. But I can go and do other things. I don't have to sit behind a computer anymore. This is the way the world's going. So funds and hedge funds have been trading this way for 5 or 10 years. We are now taking it into, working with clients, I'm working on some projects right now in the crypto space. That's why I kind of showed you GDAX. But this will run all day long, and I don't have to touch it. As long as my computer doesn't shut off, it's just going to trade for me, and that's pretty cool and it's pretty fun, and it makes my job a lot easier. And what's behind this really is it's just a bunch of. Please open this screen. Yeah. I'm going to make you sign I'm going to make all of you sign NDA. But this is just here's the code, right? I mean, this is what's behind this. Someone goes in, codes it. This is when you buy. This is when you sell. When the dot's green, do this. When the dot's red, do this. And it's just this is what's trading our markets now. Like, this is what's moving the securities markets. When you're watching it and you're seeing like, oh, the Dow's up 100 points today. It was mostly driven by computers. Like, there's really, yes, go ahead.
Do you guys hire a particular firm to write this code, or is this a commercial product that's available off the shelf and you customize it, or do you employ individuals to do this kind of work?
So we had 2 programmers on staff. I worked with them for 3 years. They went and took, now they're trading natural gas futures in Houston. So they left Pittsburgh, and I work with a firm. A guy named Brett Rader. He's actually out of Texas, and he's the one who does all the coding. So this platform, this black platform that you see behind here, is a commercial platform. It's called TradeStation. But the actual code and everything else that's not a commercial product. It's all internally developed. And as far as making this a commercial product, I'll show you that in a second. This isn't very user friendly for someone. If I wanted to say, hey, look, I'll charge you $30,000 a year or whatever to use this, and it's not very user friendly. But what we did is that's a very good transition. So, okay, how do we make this user friendly? So this is I showed you guys before when I did my talk. A lot of you weren't there. We have a proprietary, like Apple has Siri, we have Ellie, right? So Ellie makes all of our investment decisions on our behalf. And what we did is we knew the TradeStation and all that stuff was so complicated for people to use. It's not very scalable. So we had a firm out of Cleveland, Ohio, build an entire back-end platform. This computer sits in our office. It runs all day long, and this is for our actual retail clients. Now, this isn't something that we're trading every 5 minutes, or we're looking at something. We're looking at charts like this, and this is pretty interesting. We're looking at charts like, I'll go back to this. I'm rambling. Go to meeting go. We're looking at charts. Let's go away. Instead of looking at a time frame of every minute, we're going to be looking at it like weekly or monthly, and for a longer term trading for our clients. So, here's a monthly chart. Again, green means go, red means no. There's 2008. That was real fun. Here's 2000, right? Red means no. And as you run this stuff, and you get good at it, and you put a lot of time and energy into developing things, it makes our jobs a lot easier. So back to what we've created for our clients, and what we've had as a commercial product we're getting ready to sell and license, is we took all of that information and put it into a back-end platform, and this is what we call Ellie. And all of these holdings right here are different ETFs. We talked about ETFs, right? Remember, it follows it can follow any sector or asset class. So this is the Russell 2000. This is the micro caps, which are super small stocks index fund. This is the EFA growth index, which is Europe, Asia, I forget the F name. Spiders, MSCI, ACWI, XUS. Like, you could follow all of these different, markets. And then what we do is we create different sub-strategies. So here's this particular strategy. It has 6 different strategies to it. And when I say strategies, it has different, it's tweaked to have different look-back periods, meaning one's going to look every 10 or 15 days for a new pick. One's going to look every 30 days whether or not something's there, or every 90 days whether it needs to change something. And whatever is the best available out of these options that we put in here, that's what it's going to select. So what I do every morning is I come in at 7:30 and I click this little sync button, and it pulls in 1.2 million data points, looks at everything, analyzes them, scrubs them all for price, scrubs them all, so make sure all the pricing data is correct, runs everything through the algorithm, and it's going, on my home screen in the morning, it's going to say whether or not I have any trades in any of my portfolios. So one of our unconstrained all-weather portfolios had 2 trades today that I had to make, and I made them. And our foundation portfolio has a hold on it, which means it wants to change an investment soon, but it's not ready to do it, and it's going to check every day whether or not there's a better available investment. And what the foundation portfolio is it's built for institutions like your college, where they have certain investment restraints, they can't do certain things, and so that type of money goes into a foundation portfolio. But what I'm going to show you is our unconstrained portfolio. Is this making sense?
Yep.
Unconstrained portfolio, and the reason it's called the unconstrained portfolio, it can go anywhere in the world. It can go 100% cash, it can go 100% stocks, it can go 100% international stocks, it can go 100% bonds, it can go 100% preferreds, doesn't matter. Go anywhere in the world, and it has no guardrails on it. All of our other portfolios have guardrails on it because our clients have different risk tolerances. And so if we look at this portfolio back to 2014, it's going to tell us what we did. Not only is it going to tell us what we did and what our performance was, it's going to show us every single trade we ever made. It's going to show you when we made those trades. It's going to show you the price at which we made those trades. And the reason that's important is because when we're talking to new clients, you're like, oh yeah, sure, you guys have been like, you did really well, show me proof. And that's fine. I can show you every single trade we've ever made in this portfolio back to 2014. They're all time-stamped here. I can look at, so here's the yearly performance. So how many trades did it take me in order to produce those returns? So some years you have to trade more than others. So like in 2014, we had to make 58 trades in order to achieve that result. This year we've already made 28 trades to achieve our results. And it's still pretty early in the year. This market's kind of finicky. As you noticed, there was a little red dot on the chart we showed you. And then I compare this to anything in the world. So let's compare it to the S&P 500. So everything's all baked in here. Like I said, we get all the pricing data every single day. So how'd you fare? Did you beat the market? Did you not beat the market? White's us, blue's them, and we do a pretty good job. And the reason we do a pretty good job is because we don't like to participate in poor markets. We try not to, as I tell my clients, I try not to get punched in the face because it hurts. And where we create our spread are in situations like this, right? We're not picking like the best stocks continuously. What we're doing is we're trying to avoid these volatile areas and trying to get out of the market. We're not afraid to go to cash. We're not afraid to actively manage our clients' money in order to help them. I think the beginning of 2016 was kind of bad too. 2017 was just a rip roar. So that's that. Now I can go in and I can look at all these different reports and bore you with all of that. That's that type of portfolio. So let's look at this is a portfolio that's fairly risky. I'm going to pull this down. What was the return? Return is about 140% in the last, since 2014. So let's compare that to a conservative portfolio in nature. And like I said, conservative portfolios are mostly bonds. And what we do with the configuration is most of the symbols and ETFs that we have to select from. There's no, not a lot of stocks to choose from. These are all, you have convertible securities, you have quality dividend growth, corporate bonds, all short-term treasuries, much more conservative income-producing investments. And you might have somebody who's 75 years old who's like, look, I just don't have the risk tolerance like I had before. I don't need all that volatility in my portfolio. I don't need to own those things anymore. I'm looking for income. And this is going to be a much different looking portfolio. So it trades way less. We don't need to, it trades about half as much as before. This is, I call it the paint dry portfolio. It's like watching paint dry. It just kind of drifts this way across the chart. Way less risk in this portfolio, but it also produced 100% less return. What's interesting is if just by using bond investments and not getting hurt and not exposing yourself to too much risk during the downside. We're going to compare it to the S&P 500, which is totally unfair. It's much riskier, and it's done a really great job over the last couple of years. We're able to outperform by, again, in 2015, not getting punched in the face. And I'll show you what that looks like. Is you're flipping into conservative investments and bonds and things that are doing very well. And again, it's like watching paint dry. It's like a straight line, but you're not supposed to have volatility. Does that make sense? Does anybody have any questions? Because I'm kind of done. I think I'm.
He's at it.
No, but that's what we do. So to kind of tie everything together, there's many different ways to invest your money. There's many different exchanges out there. If you like trading stocks, look at the NYSE. You can get in there all day. There's tens of thousands of stocks to look at. If you think it would be fun to trade orange juice and cattle and livestock, and you think you got an edge there, then the CME is for you. If you want to try to be a gunslinger and trade cryptocurrencies, then the GDAX is for you, right? There's 100 million ways to look at everything. Everybody has their own mousetrap. Just know that the world has gone from this evolution from fundamental investing and looking at income statements and balance sheets, which is still immensely important when you're looking at private companies and smaller companies and things that aren't traded on the exchange, but because everything's driven by computers now, and there's really little human interaction with these markets, you need a computer to do that, and you have to be able to not have any emotion in the process, which is why the world has kind of gone this way. And it's going to continue to evolve, continue to grow, and it's only going to get faster and faster. So I guess my point would be, if you have interest in securities, you have interest in financial planning, it would behoove you to learn a little bit about math and engineering and some of those things, because you're going to have to know what some of that is about in order to compete in that space and have a voice in that space. So who has questions? Because I just talked for like an hour. Do you have a question? Sure.
Could you go back to that chart with the green and red?
Mm-hmm. You have no idea how many green and red dots I've looked at in my life. This one?
Yeah, so you said that if it's green, it means go, and if it's red, it means to not go.
Yeah.
So looking at the last part of it, you do see some red.
Right.
The line is generally going up.
Yep.
So is that where the human input comes in, whether to leave or stay?
Yeah, right. So if I didn't have this automated, I could be like, I'm starting to see a couple red dots here, but I could be like, economy's pretty good, and interest rates are rising, and Trump's not that bad. Maybe it is, but maybe not. Maybe I'm not going to sell now, right? Market's been so good. I mean, it can keep going. If I didn't have this here, you'd be like, oh, this is just a hiccup. Maybe it should keep going up. That's where that emotional part comes in, which is why we have computers and algorithms on the back end to say, look, I'm taking me, totally out of the equation. Your opinion doesn't matter. I'm going to act on this trade, regardless of what you think, right? So, this is interesting.
So when you look at a company's potential to bounce back, what factors do you look at?
So I'm a dot guy, right? I'm trying to think of a company that was kind of trashy recently. GM, I think, has gotten beat up. GM monthly. Change of time frame. Weekly. Yeah, see, they've gotten pretty beat up. Red means no. Okay, so we're out of here. When this starts to, when I see my next green dot and it closes there, I'm going to buy it. But those are the things we look for. We kind of talk about support resistance. If I was looking for a technical factor, but until this dot turns green, I'm not going to touch the security. Actually, I'm going to bet against it because it'll be long and short. I'm not going to. Shorting is a whole different thing. Basically, borrowing shares and you're owning them, and then when you give them back, they're at a lesser price, so you make that spread. So we actually bet with and against the market, so long and short. Shorting just means I'm going to profit in the decline of the stock.
So the white line going through there, that's the resistance line.
No, this is just kind of like a base zero. So the algorithm spits out different values. Basically, all these dots are. It's the calculation value of the algorithm. So this zero line is just kind of base. A negative dot, it's a negative output, and so it's kind of below the line, and above is very positive. And when you kind of look at that, you can start to dive in and try to put emotion in the process, right? You can be like, okay, if I get a red dot with a super high output value, it's a stronger signal than if I get a red dot near zero. You know what I mean? But we don't do that type of factor. But when some people look at strategies like this, they do. Good.
What are some of the, I want to say what your algorithm is, but what are some of the key pieces to it? What do you keep your eye on the most?
So it looks at
weigh heavily.
It looks at momentum, velocity of momentum. So like what the velocity of the move is. We look at multiple different time periods. Little whiteboard. I'll do this really quick. So like kind of the base of kind of what we're looking at, the base of this algorithm is like, if I have a stock that's trading, like this, okay? And we'll look at momentum, we'll look at the velocity of momentum, how much that's moving, but in very simplistic terms, we'll look at that momentum calculation. So if I look back 30 days, that momentum line, might look like this, right? If I look back 60 days, that momentum line might, look like this. If I look back, 9 days, it's going to be like a little bit more jagged. So what people do, and what most technical traders do, and what most algorithms do, is they look at when these start to cross, like I kind of said with the 30s and the 60s, and say, okay, there's some short-term pressure, I'm going to sell out of the stock. What we do is using it's called a, if you guys want a nap. We use digital signal processing, which is an engineering technique to combine all of these into one line. And so this is an engineering technique that basically counts the altitude or amplitude of these wavelengths, and we see which one is the dominant one, and then we pick it, and that's how that all works. So I sound crazy, but it does work, and basically what we're trying to do is pick the dominant noise regime in the market. So if you're familiar with engineering at all, I was not until I started studying this, and there's white, pink, brown noise. Pink noise is your dominant regime, it's kind of like jagged, and what we're trying to do is by analyzing all of these different wavelengths, trying to figure out which is the most dominant noise regime, and then this algorithm will self-adapt to that. Is that a long answer to
No,
question?
good.
Yeah. Do you have another question?
Yeah. So there's the concept of the elevator in finance. That would be the first or the last to invest in something.
Mm-hmm.
When the elevator's going up, you want to hop on that train.
Mm-hmm.
And when it's going to fall down, you want to hop out and let someone else take the fall.
Right.
How do you incorporate that?
So, I understand the question in terms of how we trade. Right. So, obviously, here's where we're going to hop on the elevator, right? This is where we're trying to hop on the elevator. And what we're not here. Well, here to your analogy, we're not trying to hop on the elevator here and jump off here, right? We're not trying to hop off here and jump on here. People who think that they can pick tops and bottoms in the market, and everybody you see on CNBC is a little bit crazy. What we're trying to do is play here. Once the elevator's already started to move in a direction, and I have some conviction, I'll get on maybe at 4 or 3 out of 10, right? And when the elevator starts to slow down, and I think that the algorithm thinks we're reaching the top, I'm going to try to get off at like floor 7 or 8 and wait for my next opportunity. We're trying to pick the middle floors, and that's kind of how we view it. We're not trying to pick top and bottom. There's too much risk in that. We're trying to just take a little smooth ride to the middles, and that's where we try to win. So, did you have a question?
Sure. How long did it take you to memorize all this?
So let's see. I was 15. What is that? 13 years? No, yeah, 14 years. This is all I did as a kid. Like, I mean, I played sports, but I was like entrenched. Like when people say that they have a passion for something and they're like really committed to something, I mean, I was at Latrobe High School. We were like the first high school in the country, or one of the first high schools in the country to like get laptops issued to us. And so like I got my laptop and I would open up my TD Ameritrade account and I'd be fundamentally trying to trade stocks during like health class. And I mean, that's what I did, and then I got like addicted to it and learned and failed along the way. So like started out with fundamental analysis. That didn't work, right? Well, it didn't work for me. It works for Warren Buffett, but it doesn't work for me. I tried technicals. I drew all these lines on the chart, right? And it worked, but it was inefficient. It was hard. It was very time consuming. So when you start learning about engineering and you start learning about algorithms, you meet other people in your network. Like as you start to grow and progress in your career, and you find these people that have similar interests but view things differently than you, we partner up with those people, and that's how I got here. I never thought I would be here. In fact, there's a book on my desk that's titled "How I Became a Quant," and there's similar stories. Like I didn't set out to do this. I didn't even know that this was a possibility in my life, but that's where we're at now. And yeah, just years. So I've been doing quantitative trading now for 4 years, and it's been fun. So you just kind of learn through doing and time, being patient with it. Are there so many questions?
I had a question about the previous graph.
Okay, which one?
There seemed to be a regular pattern at the bottom.
Okay.
All the peaks were about equidistant.
I think it was
apart.
GM. Was it GM?
No, GMs didn't look so good.
Hold on 1 second. This one?
Yes.
Okay.
What's the time period between the peaks?
Okay, yeah. So each one of these bars is 1 month of price data. So like this bar right here is 1 month of price data. So this is the year 1999, and this is today in 2018. This is May, April, February, January, back this way. So this is 2000 and like late 2000. This is right around 2000, like late 2007. Here we're looking, this is 14, 15, 16 was like a cluster. It's 16, 17 has been up. So this is the S&P 500 since 2000, or since 99.
Well, I guess this made me wonder, are there some stocks that you see that there is, there might be higher peaks sometimes, lower troughs sometimes, but are there any that have a regular pattern over a number of years or a number of months, and it stays kind of constant throughout?
I think what you're referring to is kind of like seasonality. Like meaning that there's certain time periods and seasons in which certain stocks might perform in a I don't want to say predictable pattern, but something of like a normal type nature. And the answer is yeah. I'm trying to think of one I used to look at. Let me give you an example. I don't know. Well, I guess the futures would be better, like orange juice, right? We talk about orange juice. So certain times of the year, you're gonna see orange juice tend to want to go one way because of the inherent weather patterns and seasons. So does that help? Does that like answer your question kind of? So there are certain stocks in inhibit certain characteristics. We're kind of agnostic of that, but what we try to do is find stocks that move. So what we don't trade and what we stay away from. Is there a plug in there? Are you sure?
Yep.
What we try to stay away from are stocks that are like flat, that don't move. So if I get like a really boring stock like Johnson & Johnson, kind of doesn't exhibit this, we won't trade it. We'd have to analyze. We've done analysis and analyzed kind of a basket of securities that we can trade. And there's a lot of them, but something that kind of flat lines is going to give us issues. We need volatility. We need momentum. We need to be able to create some wavelength in order to. But if you look back on almost anything, I mean that's the S&P 500. If you're looking at monthlies on really anything, they're all going to exhibit a similar pattern. Like here's Walmart. Again, like this is very bad for us. Like I wouldn't trade this. This is very bad for me. This is better, but something that looks like this is bad. Like I can't derive a direction. Does that make sense?
It's because you get like a minimal return.
No, so it confuses the algorithm. Like it confuses the math. Like this kills a ton of algorithms. Like when you get in a channel, which is why you guys probably didn't read any of this, like 15 and 16, like most hedge funds across the country like blew up. The returns were really, really, really bad. And the reason they were really, really, really bad is for a very brief period of time. I'll come back to Walmart for a second. For a very brief period of time, this cluster here happened, and they didn't know what to do. And this was very volatile. I mean, we had like 15-20% moves, and sometimes it would move like 7 or 8% a day. And like you just have to survive in these times. Math-based programs work on things that move. I mean, there are very short-term trading algorithms that'll work here, but yeah, to answer your question.
Yeah, so you're like trying to make it so it's like obvious that you need to sell your stock or.
Yeah, what we're trying to do is find things that work for our strategy, right? If you have a strategy that works on stocks that only move sideways, you're going to create yourself a little channel of support and resistance, and when it hits, resistance, you're going to buy. When it hits support, you're going to sell it, and you'll find things that work for your strategy. One mistake that and it was a mistake that we made early on, is they're like, look, this algorithm's great, we trade on anything. Well, that wasn't true. I mean, you had to find what you could use it on. So you could go to a mousetrap, but a mousetrap's not going to kill a moose, right? A mouse is going to kill a mouse, and you have to have different instruments to trade what fits your strategy. And people make that mistake all the time. Yep.
So I think it was American Airlines or one of the other companies where they had an incident of brutally taking a person off the plane, and because of so, their stock value plummeted. Does LA incorporate some version of the public opinion and personal relation of a company?
Oh, that's like a really good question. I love that question. What is American Airlines ticker? I forget. You guys all have cell phones. American Airlines. It's American. Is it AA or is that Alcoa? American Airlines stock. AAL. That's a very good question. Okay. Ooh, I should trade this. So, no, in the general sense, no. Ellie doesn't go out and find a piece of news to say, oh, this is bad, we should be out of this. But, in order to participate in markets and act on something, you obviously have to make a trade. right? So everybody's public perception is viewable in these charts, right? So when somebody says American Airlines is a bad company, and then a bunch of people start believing that, and then a bunch of people start putting money behind that, that perception is going to be exhibited by price. Price is the only thing true in the market. Someone can tell you that they think Google's the best stock in the world, but until everybody else thinks that and starts to push money that way and the stock starts to move, well, that doesn't really matter. You're just kind of sitting on opportunity cost, right? So to answer your question, directly, no. We don't go out and say, okay, this is bad, we don't want to trade this anymore or short this. What we'll say is, what we're doing is actually looking at the price data and saying, okay, people are pissed, so we should probably not be in this, just based on the price data. Go ahead.
So because Ellie is an algorithm, I assume then that the factors that she takes into input is all factual.
Mm-hmm. It's only price-based, price and price only. Because price is the only thing true. If I say to you, I'm going to buy your car for, $500, and you're like, all right, I'll sell it to you for $450. We don't have a deal yet, right? Or I guess you're going to want more. I'll sell it for $550, right? We don't have a deal yet. And until we make a deal, then it becomes a fact. So we only trade on price and price only. Take no other fundamental data into consideration. You can say whatever you want about what something's worth, but until someone actually is willing to pay for it, and that's proven in the market, then it's not true. It doesn't matter.
Numbers don't lie.
No, numbers don't lie. What else? Anybody else have any questions? Sure.
This all boils down to an educated guess
Correct.
on what's going to happen.
That's right.
Now, from what you showed, you make much more money when there's a trade.
Mm-hmm.
There's administrative fees, but you make your money on the trades. So
On the spread, yeah.
who's policing that? Where's the ethics come in that you would advise clients to buy or sell just because your commission or the money you get?
Okay,
Who's
yeah.
policing that?
So we don't work on any commissions. We don't earn any commissions personally, right? What we do is we come to you and say, well, I'll manage your money all for a fee. So I'll charge you $1,000 and I'll make as many trades as I want, right? I'm not going to charge you any commissions at all. So there's two types of advisors in this world. There are the fee-only independent advisor, which is what we are. So we don't work for Merrill Lynch or Morgan Stanley or a bank or a brokerage. We legally can't earn commissions. Okay. And then there's the brokerage side, which says, hey, look, I think American Airlines is a great stock for you. Let's make that transaction, and then I earn a commission off of you, right? So that's your bank broker dealer. That's your broker world. So yeah, we don't work on any commissions, which is why I have the duty by law that I have to put your best interest ahead of my own at all times as an independent fee-only investment advisor. So, I mean, on the other side of the street, on the broker side, they only have to do what's suitable for you, regardless of the commission or fee. So what that means is